Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for November 27th, 2023. Well, first of all, welcome everybody. Hope you had a wonderful Thanksgiving. If you were traveling, hope you enjoyed those travels. If you were with family, hope you enjoyed the family time. And as we kind of get back to business here in the week after Thanksgiving, got a lot of things to talk about here. This first slide I came across in my weekly reading from the Wall Street Journal kind of shows you over the last 3 years the rate of inflation on things that we enjoyed on Thanksgiving Day. You can see here turkey, pies and tarts and things like that. Biscuits and rolls were all up about 25% over the last 3 years. So as we kind of talk about inflation, it's important to note that inflation hits us in a lot of different places, and not the least of which certainly is our Thanksgiving dinner table. You can see gasoline up top. That is there for really the discussion of having to travel to go see family, and you can see gasoline is much higher than it was, although it is certainly down from its peak. So inflation again comes at us in a lot of different directions, and I thought I'd post this one here for a little bit of seasonal impact here. Well, we're getting ready for the crux to the holiday shopping season, and this slide tells us how important the holiday shopping season is to retailers. And we've talked about retail sales slowing down a little bit. We've talked about the potential impact to the consumer on excess savings going down. We'll talk in a minute about how real wages are still, I'd say, agreeable to some extent. Still supportive, I guess would be a better term for it, for continued spending. And that's really been the story this year on why we haven't seen this slowdown pronounced yet in the economy, is because the consumer's been pretty strong. Well, you can see here the impact. Department stores, 33% of their sales come during this time of the year. And you've got electronic stores, beer, wine, sporting goods, all of this. I mean, you can see all of these categories here are above 25%. And you can see here clearly total retail sales, 26.8, almost 27% of total annual retail sales comes during the holiday shopping season. Now we'll switch for a minute and talk about central banks and interest rates. Here we have an interesting chart from Deutsche Bank and Haver Analytics, and it depicts the number of total hikes and cuts on the part of global central banks. So just to underscore that this whole interest rate conversation is not just a U.S. thing. I mean, the central banks around the world are debating this, and it has implications for currency movements and all sorts of things. Trade balance and all sorts of things like that. And so it's very interesting to see where we are now. And you can see how, this number has kind of pivoted through time, ups and downs. And where we are now is we saw a lot of interest rate hikes on the part of global central banks, at a time where, we were post-pandemic and interest rate cuts were kind of basically ebbing here. Now we see, central banks beginning to ease a little bit, and we see the number of hikes going down. And so as we sit here in the U.S. talking about whether or not we think that we're close to the end or maybe at the end of the rate increases, and that we're closer to maybe some of these decreases, just know that this is something that's going on around the world right now. To understand this chart, you really have to, kind of just appreciate the fact that estimates can change over time. And so what we have here is a bevy of monthly inflation forecasts dating all the way back to 2018. And so every month, when you have a new data point, and the actual number is depicted here in this solid black line. And so every month after that, there's estimates as far as what's going to happen to interest rates. And so inflation. So as inflation has gone up, the perception is, back in 2021, everyone thought it was transitory, it would go down. Well, obviously it went straight up. And every month along the way, the forecasters thought, okay, this is going to come down, this is going to come down, this is going to come down, but it kept going up. Well, now we have seen inflation roll over in a pretty appreciable way, although I think it's maybe less appreciated by some who feel that it's still sticky and still above this line here, which is the Fed's 2% target. But it is coming down. We had a little bit of a hiccup here, but you can see that all of these estimates, when you get down to beginning of 2025, that most of these estimates now are coalescing really close to that 2%. And so, when you think about inflation dropping, and if you believe these estimates, and again, take stock of the fact that a lot of these earlier monthly estimates were just flat wrong. Inflation turned out to be a lot stronger than anyone anticipated. But if this is going to happen, you're going to see probably some interest rate cuts, but maybe not as soon as people think. So anyway, I thought this was a very interesting chart, and I'm sure we'll be debating and talking about these forecasts for many months to come here. So we have two really sticky components to inflation, and the first is rents, or owner's equivalent rent, OER, which is over a third of the overall consumer price index and roughly 40% or so of the core. And so you can see here, and the other one being wages, so wage inflation. So here we're going to talk about, just for a second, housing prices and rents. And so you can see here, CPI less owner's equivalent rent, you can see that that's rolling over. You can see primary rents, which is really important here. And there is a statistical and a mathematic difference on these two components. You have Zillow observed rents, and I've talked about this a lot, where you have this data that's calculated. So owner's equivalent rent is, essentially a measure of, if you were, renting your home and you owned it, what would that economic rent be? And so this is an imputed figure, and it's been higher than what we've actually observed in the data. And so this is really important to note that Zillow observes rents. They track it, they collect data and they report it. And so those observed rents have dropped considerably, but the imputed data has yet to catch up with it. And I think, just as the headline here shows, housing slowdown, when we get a little bit of steam out of this and interest rates are still high, even though mortgage rates have come off their peaks, that housing is still relatively slow. And so this should help provide some disinflationary impetus for overall inflation in the CPI. As I said, the other primary sticky component to inflation is wages. And, this comes to us from Indeed. And you can see here that you have, imputed data, which is their wage tracker. And you can see that in this blue line. And you can see from basically last year through this year that we're seeing a fairly continuous and pronounced decline in wages, but correspondingly, we've seen a pretty strong drop in inflation too. And so what this tells us right now, and this has been in place for most of this year, is that we've had basically real wages positive. So we've got wage tracker, the wage level of wages above inflation, and so we're getting real wage growth. And so that is inflationary to the extent that it's persistent. And so, it is important to note that I think while we might see some relief on that owner's equivalent rent in the prior slide, a disinflationary impetus to inflation, that even though we've got wages moving down, real wages are still positive, which is good for the worker, good for savings, good for consumption, but it's going to cause a little bit of stickiness in the inflation factor. This slide will take just a second to kind of absorb. And so when you think about this, when the Fed has commenced a rate cut cycle, and just to level set here, I mean, we feel like we're at the end of the rate tightening cycle, and so the next step, hypothetically, is a rate cut. And we don't know when that's going to come. It may be a while, but when they do, this is a plot of unemployment rates and core CPI inflation when that happens. And so what you see here is, back in September of 2022, we had unemployment rate that was at historic lows, and we also had very high inflation. And so, really over the last year, we've meandered this way. So, I mean, our unemployment rate has moved up slightly, not too much though, but the rate of inflation has dropped below 4, and so that's good, right? But when you think about from a historical perspective, where the combination of these two things are when the Fed typically begins a rate cut, you see that this is definitely an anomaly. You can say, well, you could argue 2019 was in the same boat, or 2001, that was really in the throes of the tech bubble. There are a lot of other factors going on. But usually, when rate cuts come about, you see unemployment rates that are above 5, and sometimes, unfortunately, a lot higher than that. And that you also see an aggregate level of inflation that's perhaps a little bit higher than where it is now. Not always. And so this is a relatively imperfect chart, if you're trying to plot a line of best fit. But it is kind of interesting here that right now we sit at this juncture right here, but most of the time when the Fed begins to cut rates, unemployment's a lot higher than it is today. So in this chart, we have commercial bank deposits. You can see here very clearly over on the far right that deposits are still going down. We were, when we were issuing checks to people during the pandemic, they went way up and then they've gone way down. So this is very consistent with a disintermediation. And I'm going to show you on the next chart where those deposits are going, but just know as well that money supply growth is currently negative, and so that is actually helping to contribute to that. And so when you think about going back to 1975, this is something that we haven't seen but extremely rarely, and at that point it wasn't very much of a decline. Now we're seeing a pretty pronounced decline, and honestly it has to do a lot with maybe some confidence in the regional banking sector. It has to do with interest rates being competitive elsewhere because interest rates in general have gone up. But we want to watch this. This is for the health of the overall banking sector, and particularly of small and regional banks. Well, here's a chart showing our money market mutual fund assets, and so just as we saw in the prior chart, that those conventional banking deposits are going down, we're seeing money market fund assets going up. Now, there is something embedded in this that's really important, and that is when you think about assets in banks. Banks use those in a fractional banking environment to make loans. So, right, there's a money multiplier. So for every dollar of assets or deposits, you can make basically $10 worth of loans, which are assets to a bank. Well, if you have fewer deposits, then that decreases your lending power at the same time that banks are pulling in credit-wise anyway and being more conservative. This is kind of exacerbating that situation right here. But the fact of the matter is that investors can get pretty good yields on this money right now. We're going to talk about the index of leading economic indicators. And so a lot of good data from a lot of different sources, Charlie Bolello, Liz Ann Saunders at Schwab, and this is a pretty consistent theme here. And so, again, I'm not here to tell you that, we're going to go into recession because of this. There is a pretty high correlation, at least to an economic slowdown. So this is something that I actually spend a lot of time with looking at on a trend line basis. And so what we have here is the Conference Board index of U.S. economic indicators. And so, you can see here in these shaded areas, we've got recessions, we've got periods where, the LEI is weak, again, right here back in 08, and there were a lot of other things going on in 08. Pandemic, it was negative. And then, we've had pretty consistent negative numbers over the last, really almost the last 2 years. And you can see that there are times where the LEI is negative, and it's kind of a false signal, if you will. But when it's consistently negative, notwithstanding the pandemic, and that was a totally different issue, but when it's been consistently negative, you should expect an economic slowdown. In this chart, also of the LEI, it shows us that we are now 19 months of consecutive negative LEI. Like I said in the last chart, we're almost 2 years. And usually when you have durations like this, where you have consistent negative periods of LEI, you're at or near a recession. And so, don't mean to show this to scare you, just to say that this is something that we're watching. We're kind of girding portfolios to this. We're not buying into the hype of these high-flying, high multiple stocks. Even though they sound real sexy, and we'll talk about that in just a little bit, but high multiple stocks in an environment where you have an economic slowdown, and just that those numbers just don't work over time. If you believe this is going to lead to slower economic growth in the months ahead. Continuing here for the last slide on the LEI, this is actually a plot of a math problem here. And so it's taking the leading economic indicators and it's dividing them by the coincident. And so, as this would tend to imply, if, this number is going down, then your leading economic indicators are weaker than your coincident ones. And so, when you have a decline in your LEI, relative to its coincident indicators, and that usually, again, leads to economic slowdown. And so that's exactly where we stand right now. So for every data point that I show you that would imply that the economy is slowing down, there is usually a data point that kind of tends to refute that. And so here we have some data from worldeconomics.com. It's a UK-based analysis service. Do a lot of good work. Here they have sales manager index up above 50. And so these are all diffusion indices that you see on this page, which means that everything above 50 represents some level of expansion and everything below it represents contraction. And so here, just in its most basic form, you can see right here that it's above 50. It's been consistently above 50 with some rare exceptions where it's dipped below, but it's then come back up. So it's hugging that growth line, but it is still positive. And you look at business confidence, hasn't always been positive, but it's positive right now, for what it's worth. Even though we know that CEOs are maybe a little bit less constructive than this number might imply. You got market growth index still positive. Sales growth is still positive, and with a couple of dips below the 50, the water line here, so to speak. And then prices have been consistently up above in expansion mode, which from a business owner's perspective is good because you have pricing power. So not to get too caught up in all of the minutia with regard to the LEI versus this data from worldeconomics.com. But just know that there are differentiating points of view, different calculations that tend to imply different things. I think the consensus is clearly that things are slowing down, but they're not really negative, at least not yet. On this slide, we have the University of Michigan sentiment number. This is heavily influenced by inflation expectations. And, we've seen some, fits and starts. We saw, obviously a dip when the pandemic happened, then we saw a resurgence, and then that's been weak, and then it got better. And we're now 28 straight months below 75, which, is something that we haven't seen in quite a while. So we had 28 straight months down here, kind of leading up to the global financial crisis, and then similarly back here in 1980. And so, this doesn't happen very often, but, sentiment is weaker and has been consistently weaker for a number of months now. So we do talk a lot about labor, labor supply and employment, job growth or decline, so on and so forth. This is something that I don't show a lot, but it does have some pretty important ramifications here. So, labor supply is usually something that it kind of serves as a bit of a lagging, indicator on economic growth because, you see business conditions evolve and then businesses react to that by adjusting their demand for labor and their and also you have issues on the personal and consumer level that kind of affect the supply of labor. Well, oftentimes we talk about, the new applications for unemployment insurance. This is actually continuing claims. So these are more durable claims, and I think it's a less noisy indicator. And you can see here overlaid in red periods, we've got recession periods, and then we have periods of, downward as you have economic expansion, that number goes down. Again, post expansion, then we have the pandemic. Where we are right now is we're picking up. Again, I'd say the labor market on balance is pretty strong, but it is weakening somewhat. That much is not in dispute. And so we do see continuing claims perk up, but again, it's not something that gives you a lot of concern just yet. On this slide, we have the 30-year fixed mortgage rate. Good news here is that rates have come down a little bit. They're below their peak. Now, we basically, depending on whose calculation you're using, this is Freddie Mac, but some other bank rate calculations were much closer to 8%, but you can see here with 10-year yields coming down that that's something a little bit more closer to about 7.4% right now. Continuing on the housing theme here, this caught my attention. This is basically, purchases that fail, right? That people cancel their contracts. That they're either not motivated, they can't qualify, there's some other reason why they're canceling their home purchases. And you can see that this number over time has been a little bit noisy, but been kind of along this line of best fit. But you can see here that, when housing prices spiked, that was obviously an issue, and it's become an even greater issue. In fact, this is data from Redfin. This is the highest level that they've ever seen. We're closer to about 17.5% of these total transactions that are being canceled. Here we have a little bit of noisy information. We got two data series plotted here, both kind of housing related again before we exit this topic. In the blue line, we have the National Association of Home Builders Index. This is kind of their sentiment index, if you will, and you can see how it's jockeyed around, and obviously, it gets impacted to a certain degree as you're heading into a recessionary period, and it tends to go up during expansions. And so here we are now at this juncture, and so we've come off this peak after having consistently risen over many years, right? So this has been evolving for a long time. And then we had a little bit of noise here, again, pandemic ripples kind of notwithstanding. We're at a low point, but in the amber line we see basically housing permits. And right now, at this chart, there is a reasonably positive relationship here. Now, sometimes it tends to lag or drag, if you will, but usually you don't see a point where, you're moving higher at a point where basically home builder sentiment is going down. And so a lot of this has to do with access to capital, so to speak. And obviously what we saw in the last chart, a lot of housing transactions are falling through because, a lot of lenders are getting tighter and people aren't able to get financed, especially if you have lower credit scores. But this is something that tends to reconcile itself over time. And so the thought here is that maybe housing permits go down in the coming months. So now we'll talk about the federal deficit here. This is something that's been on my mind quite a bit over the last year or so, and with good reason. I think we talk a lot about monetary policy, and that's what the Federal Reserve has domain over. That's manipulating short-term interest rates, and the tools that they use to try to influence interest rates, so on and so forth. Now, fiscal policy is the complete domain of Congress, and so this is the federal deficit in a nutshell. And so I actually love this chart. It goes back a long time. You can see here that for many, many years we ran, from a relative standpoint, a relatively low deficit. Now, granted, the economy was a lot smaller back here, going back 1970 to 1990, the late 90s. But it was a manageable deficit to some degree, and a lot of people were concerned about the deficit back then. Well, then Clinton comes along. We kind of like won the won the war against communism, so to speak, and we ran surpluses for a number of years, and then we had 9/11 and the wars in Iraq and Afghanistan that changed, and we had a global financial crisis, and then we kind of worked our way out of the rut. But here we are now. We had all of the stimulus, enacted during the pandemic, and of course, we haven't seen a pandemic since 1918. So, we didn't know how to react to it, and what Congress knows how to do is spend money, and so we had a pretty sizable deficit, worked our way back, but we're currently about 1.7 trillion right now, and that's something that we ought to take stock in, because the risk is that if we don't get our spending house in order from a fiscal standpoint, we're mortgaging our future and putting a lot of burden on the generation that comes after us, and then the generation that comes after that generation. So this chart shows us the non-financial corporate net interest expense here, and this is something that you really have to kind of study and read, because this chart would tend to belie the current situation. Obviously, with interest rates moving up, we know that interest expense is moving up, but unlike the federal government, non-financial corporations can store idle balances and get interest income off in that. So what we're seeing is crafty corporations that are able to earn more in interest than they're paying in interest expense on their outstanding debt. And we know that going into the last, essentially going into the pandemic, that corporations had pretty strong balance sheets. And so, they're earning a lot of interest income, granted that we have now a higher interest rate regime. So now it's time to shift our focus to the investment markets from the economy. And here's something that I feel like it's important to start off with. I've shown you this here recently within the last month or so. But here we have in the black line, this is the Bloomberg Economic Surprise Index. And so we watch that black line, and it is clearly kind of rolled over. I wouldn't say that the things are particularly negative. They're just not really positive right now. We are getting some linear data points that are above the prior readings, and we're getting some positive readings in certain, like, manufacturing indicators, so on and so forth. But on balance, we're kind of evidencing a slowdown, and it's been taking place ever since September. Meanwhile, we've got the S&P 500, which has been on a little bit of a little resurgence here. And so, we saw the sell-off late summer, after having, picked up considerably after the Silicon Valley Bank failure. We had all those magnificent 7 stocks. We're going to talk a lot about that in a second. But then we have this market sell-off, and the market's taken off again. And you can see the relationship. Again, this is going back to basically, not quite 2 years, but there is a positive relationship here. And so this is a very odd circumstance. And so, we've got the index here that is being completely led by these high-flying tech stocks at the same time that economic indicators are going down. And those things just don't persist for long periods of time. And so that's what we're watching here in the coming months. Here we have year-to-date returns and a lot of different indices, depicted here. We've got the NASDAQ 100 all the way down to the S&P 400 mid cap, and then this black line here is the S&P 500. And so you can see that not all indices are made the same. So NASDAQ 100, again, dominated by the high-flying tech stocks that have extraordinarily high price to earnings ratios or valuations. And then you have, the laggards down here. So you've got the micro cap and the small cap, the Russell 2000. We're going to talk about that in just a second. But, these have really not carried their weight relative to what the broader market is doing. And I think, again, we tie this back to the last chart and we show, economic surprises are going down. We know the data is softening up a little bit. And then you've got these high flying stocks that are, basically carrying the index. And it's just not a sustainable type equation here. So as you talk about, the impact of the high flying Magnificent Seven, if you will, you can see those that are depicted here. Facebook, Meta, Apple, Amazon, Google, Microsoft, NVIDIA, and Tesla. I'd say NVIDIA, you can circle that one a couple of times, and Microsoft certainly a couple of times, because those have had an outsized influence. But, just to kind of show you what the impact is, looking at it from a different perspective, not from the perspective of what these are performing, but what the rest of the other 493 stocks in the S&P 500 are doing. Through November 17th, they've returned about 2.6% this year. Again, if you add in these Magnificent Seven, the index looks a lot better, but the other 493 stocks are kind of dragging their feet a little bit. And actually, the rate of return on the other 493 is below the rate of cash as defined by the 3 to 6 month T-bill index return. So here we have the same issue kind of depicted in different terms. You can see here, this is the 2.6 that we're talking about with the other 493 stocks in the S&P 500. And here's the impact of all of those high-flying technology stocks. So we have kind of a similar issue when we look at the Russell 3000 here. And so, we have the same Magnificent Seven stocks that are also represented in the Russell 3000 index. And so if you look at the return of the other 2,993 stocks in the Russell 3000 index, that total returns about 3%. So if you back out the Magnificent Seven here, the return in the market's been about 3% this year. And so that, interestingly enough, is below that rate of cash that we talked about in the last slide. And so when you think about, the ability for the equity index here in 2023 to outperform cash, it's only because of these stocks right here. Here's a chart of the equal weighted index. And so this does actually include the Magnificent Seven. It just says, all right, instead of capitalization weighted, and of course the Magnificent Seven have, account for 30% of the index. And if you say, all right, well, each of the 500 stocks in the index has an equal weight, well, you can see here that the market returns, looking over, a multi-year period here, about a year and a half, they've kind of, meandered sideways a bit, and so, we haven't seen the kind of breadth in the market that we have in years past. Now, that having been said, the equal weighted index is, shows a very distinctive positive and upward sloping pattern over time. We just haven't had it over the last year and a half or so. And that's not to say that it's not going to come, because it will. Usually we have the largest gap right now between the capitalization weighted returns and the equal weighted returns that we've seen in many, many decades. This chart a little bit wonky, but basically it's a plot of normalized price to earnings ratio, and then in the x-axis, and then the y-axis is subsequent annualized 10-year returns. And so we haven't talked about this in a little while, but where we have we just got through talking about, the equal weighted return or the returns if you kind of mute the impact of these magnificent seven. And right now, that price to earnings ratio is about 16 and a half times, maybe 17 if you really want to average up. And so at that level, over the next 10 years, you should expect something closer to kind of an average market return, about, 8, 9%, maybe a little bit higher than that. The normalized PE, assuming the S&P 500 all in, the capitalization weighted index, that's something closer to about 22 times earnings. And so, if you believe that that is the true barometer, then your expected return looks more like 5% instead of, something closer to 10%. But I tend to think that because the economy's slowing, it's going to have an impact on these high flying stocks, and we're not going to see the rate of change and the gains that we've enjoyed on those stocks certainly over the last 9 months. And so, the PE is going to look a lot more like this once those things normalize, and that equal weighted portfolio is going to give you reasonably decent returns over the next 10 years. I added this chart because I thought it was pretty interesting. Again, a little wonky here, but it plots relative volatility against annualized return for different things that you do in your portfolio. And so, if you this is really a slide that helps to emphasize diversification. And so, really the takeaway here is that if you're adding high quality dividends. And these are other things that you can add to your portfolio: international dividends, emerging market dividends. But if you add, quality and dividend growth to your portfolio, that tends to improve your annualized return over time while not contributing to excess volatility. Here we have profit estimates again for the S&P 500. Just to be clear, we just got through talking about price to earnings ratio, and that is price divided by earnings and earnings expectations. Well, it just so happens that those expectations are going down, so that it helps to keep that PE multiple inflated. And so you can see that, for 9 straight weeks now that we have had downgraded earnings prospects looking into 2024. Here we have earnings estimates depicted a little bit differently from our friends at Fidelity. You can see the S&P 500 here in the black line. We've talked a little bit about the gyrations in the market here to date. This is going back to October of 22. So this is about a year right here. And so we saw the upward motion, downward, then we kind of picked up on the heels of these tech stocks. But correspondingly, we've seen kind of a pickup here in the forward 12 months earnings. And so right now we're looking at about $240 a share for earnings. And that's, based on, about 4,500 here-ish on the S&P 500. And so, we have multiples that are a little bit elevated from where they have been recently. Here we have earnings breadth. I mentioned this a second ago. This in the pink is what I want to emphasize. What we have in the black here is just the S&P 500. But in the pink here, this is the percent of companies in the index that have a higher next 12 months earnings per share versus 3 months ago. So this is kind of like highlighting the impact of all those earnings downgrades. And so basically, we only have 41% of the entire index that has higher next 12 months earnings per share estimates versus a year ago. This chart I added because when I talk to people and they get jittery and they want to go to cash, and one of the problems with that is it's very hard to know when to get back in the market. And so if you go back to 1980s here and you say, like, the theme of this slide is there's always a reason to sell. Okay, you got Gulf War, you've got government shutdown, you got the crisis in Asia and the Russian ruble, and you got the tech bubble bursting, and for a short period of time, that would have been a good trading call, but you never know when to get back in. 9/11, all of this stuff over time, and look what happens to the index. So if you remain steadfast, this is a chart that kind of really speaks to the younger generations, because if you're steadfast, this stuff works itself out. You get these dislocations in the market, and it's painful. But over time, you get that upward sloping motion that's very important to total return if you take the emotion out of it. Here we have a slide on volatility from Charlie Bolello. This is very interesting here. We just have very low volatility, and this is not something I would have predicted at the beginning of the year. If you have an economic slowdown, you tend to have higher volatility, but it's been stubbornly low. And anything honestly above like 27, 28, I consider that to be pretty high volatility. But we're at 12.5. This is the lowest point that we've seen since January of 2020, which coincidentally enough was just before the pandemic and the shutdown. Here we have a slide on the Russell 2000. We just talked about that in terms of earnings growth and the relative performance of companies in the index and so on and so forth. But this is an interesting chart that is interesting in many respects. One, because the aggregate current numbers that we got 40% of the companies in the Russell 2000 have negative earnings right now. So obviously not contributing to the E in the PE ratio, and in fact making that PE ratio higher. But what's also interesting is this is happening over a longer period of time. Back in the late 90s, you only had 15 to 20% of companies with negative earnings, and even when you broke down and you had kind of like the pre-recession cycle trough here. I mean, it was still only about 18%, and to think that we're now at 40% is pretty interesting, and it does have some, I guess, collateral impact on how you think about that index. If you're getting close to half of that index is not even profitable, then what does a PE ratio really mean? What kind of constructive value does it have anyway? So a couple other things that we've talked about in passing. One right here, we've got the 10-year Treasury bond yield. That has clearly moved down. We saw that manifest itself in lower mortgage rates. So we peaked at 5 last month, and now we're in the 4.4 range. And where we go from here is really a function of expectations and data flow and noise coming out of the Fed as we enter 2024. But this range here seems very reasonable, and I'm not sure that we are going to get up to 5% again, because this is building in expectations that interest rates are going to fall. And so we've kind of resumed the steepening of the yield curve, because as we know, short-term interest rates are still noticeably above 5. So here we have a chart kind of dovetailing on interest rates moving lower is the dollar index. And so, dollar was extremely strong at the end of last year. That was a headwind for commodities. It's a headwind for emerging markets. And now that's rolling over. And so the aggregate change here is maybe 5%, which is notable, because the dollar tends to not have, those types of moves in a relatively short period of time. But again, a lower dollar is very constructive for international markets, constructive for trade, constructive for commodities, and certainly constructive for emerging markets heading into the new year. And then we have gold. So gold is a safe haven when you have volatility. Obviously, I showed you 2 slides ago that we don't really have volatility. But it is catching a bid right now. We're back to levels that that we saw back in October, and we've had a really nice move in gold. We had a lot of weakness in the equity markets through this transition, and then gold has actually kind of dovetailed to some extent what equities have done. but we're seeing some pretty strong performance out of gold as of late. That's all we have this week. Hope you have a wonderful week, and we'll talk to you again soon.